Hi, in this video I'm going to talk about financial bubbles and capital flows. I'm going to follow a paper by Ventura from 2012. So, what are bubbles? Well, bubbles are assets that do not have any intrinsic value. People just buy them because they think the price of them is going to go up. We usually see a lot of stocks traded in the market that just seem to have periods of time in which their prices go up for no apparent reason, and that might be a bubble. One of the reasons why people buy them is because they expect to make a large capital gain by buying low and selling high. Now, imagine you're the average wage earner who has some savings. Well, you could either invest those savings in producing, and that is, you invest in capital, or you could buy the bubble. Now, if you're a productive guy, if you're very productive, then it's good for you to actually go out and invest in capital. But if you're not productive, well, it can also benefit you to buy the bubble. Ventura takes this intuition and applies it to different countries in the world. Now imagine that you have some productive countries and some countries that are unproductive. What he says is that unproductive countries might want to buy bubbles instead of investing into producing capital because this might be good for them. So why is this the case? Well, imagine that your country is packed with very inefficient producers. If these producers were to invest their savings into producing capital, then their consumption would be really low because they're bad at producing. They're not very efficient. But if instead they buy the bubbles, they will be able to get a much better return just by buying and selling the bubble than they would have if they decided to produce capital because of their productivity being so low. But then, if all the unproductive investors buy bubbles, the bubbles basically absorb the savings from these inefficient investors, and the bubble ends up crowding out all the inefficient investment in the world and shifts this investment towards more productive countries, leading to more growth overall in the world and also to more consumption because unproductive countries are getting their returns coming from the bubbles, which is higher than they would have gotten if they invested in capital, but also the average productivity of the investment that is undertaking goes up. And this is a basic reason why economic growth in the world goes up due to the bubble. Then if this is true, we will end up seeing that in low productivity countries, there's large bubbles, and in high productivity countries, there's barely any bubble. Because their high productivity makes it more efficient to produce capital than to buy bubbles. Watch my next video to see the model that Ventura provides to explain this intuition.